And those calls that have grown quite loud that the Fed should maybe do nothing at their upcoming meeting, and they should just kind of take a look around and wait and see and let everything filter through the system before they cause stress that they can't reverse.
Well, we don't know what the right answer is or wrong answer is because, as you're alluding to, or in fact saying, we don't know what's been done to the economy from the rate hikes thus far. However, I still think that it's a waste of time to have the pivot discussion right now. And by the way, the Fed's not going to do it. Think of the credibility they would lose if at the upcoming meeting they just said, just kidding, we're going to let Europe, we're going to let the tail wag the dog. It's not going to happen. They've still got untenably high inflation here. And by the way, why is nobody talking about OPEC potentially taking out 1 million to 1.5 million barrels and reversing the declines in oil prices and prices at the pump? So you see, there are too many variables. The Fed's maniacally focused, as they should be, on bringing down an overheated commodity and an overheated labor market. And they're going to keep doing it. And to think otherwise is a mistake, and I think a pretty bad investment case when the very fact that you're talking about damage that exceeds what people can imagine in the market is what's going to hit stock prices. Because earnings will come down from that and from the currency.
But my point is, like, high stress within the global financial system is the one thing that could cause the pivot, right? The Fed is not going to watch the U.S. stock market go down in a level that it has and said, oh, my God, we need to make a pivot. It's always been about credit markets and increased global stress, self-inflicted or otherwise, by other central banks that may have run-on effect that cause conditions to become, Victoria, even more tight. That's the one thing that could cause a pivot, or one of the things that could cause a pivot that changes the calculus for stocks, perhaps.
Look at the UK, the poor guys. I mean, they went out with this, oh, we're going to cut taxes, we've got this plan, and then 10 days later, they're reversing course. They have to step into the bond market. They have to intervene because of liquidity. We've always said the only two things that will cause the Fed to move is unemployment going up or lockup in liquidity, and they will care about a lockup in liquidity. So I think that's what their emergency meeting today was about, is what's happening in the UK. Is there a risk of contagion? You know, everybody saw how that worked in 08 or in 2020. We are so interconnected. The fall of sterling, fall of euro, fall of the yen, and the U.S. dollar strength, they are all interconnected. So we aren't just in a bubble here. We do get affected by other economies, and you have to look at what's happening. And the U.K. now is in a very bad rock and a hard place, right? They've got high inflation, 11% or so, plus now they're potentially having to ease in a market they were trying to actually tighten. And are they going to raise rates, and what's the BOE going to do? And I do think that the Fed has to take a pause and say, what is the global health right now? Because the risk of contagion is always extremely high, and sometimes that can get out of control. So if there is, and I don't even like to use this word, but a slight panic, then you have to worry about that bleeding into our market. So I do think it's the right for the Fed to be concerned about it, but I do think they should still stay data dependent and see how it's playing out in the UK.